Howdy, Jacob here. Today we're looking at the Clorox company in the household products industry, 17.7 billion market cap on just under 20 billion enterprise value. I'm surprised. Well, I guess it's a small growth company, so I expected it to grow a little bit more post COVID and during COVID. But I mean, I guess 8 to 9% for them was a pretty substantial increase in revenue. Otherwise, we're getting back to normalcy here where it's actually gone down 2 of the last 3 years. Gross margin, pretty solid, 43%, with an operating margin down from 10 years ago and down from their COVID highs, but still double digit, so not terrible. Play a pretty big dividend, so substantial, in fact, that the last 3 years it was greater than their earnings per share. So we're going to have to assume something about that. With return on invested capital used to be great. Recently, single digit, return on assets single digit. Otherwise, if it were to be able to go back to those 16-15% return on asset, 25% return on invested capital, I mean, it doesn't matter because they're paying so much in a dividend. So I guess it really wouldn't be reinvesting that much. They wouldn't have a lot of capital to be able to reinvest back in themselves to grow exponentially at those immense rates of return. So the balance sheet shows 202 million cash on hand, 4 million short-term debt, 2.5 billion long-term debt. Quite substantial amount of debt for this company. I believe they've been around for quite some time. Yeah, 1913. It's been over 110 years. So, I mean, I don't think they're going away anytime soon, but I do think that's a pretty substantial amount of debt. So let's look at what that is in relation to their free cash flow. So cash flow is producing, if we're being generous, pretty generous, let's say $1 billion, then, I mean, that long-term debt really isn't that much of a concern. It looks like they're producing a bit more free cash flow than debt or than their net income, which I prefer. It means the company might be doing some one-off expenses, and maybe they're depreciating, amortizing stuff greater than their capital expenditures, which, I mean, I guess you'd really have to look into what they're depreciating and amortizing, making sure it makes sense. But in actuality, but for their depreciation and amortization to be greater than capital expenditures, meaning they're, just being able to produce a hefty amount of free cash flow here. And that's really what we're saying. And their use of free cash flow is very substantial on the dividends, as we saw before, where they're paying $583 million in dividends. And, for being generous, $1 billion, but realistically, their average is more like 80 million. And so you're paying 70% of your free cash flow in a dividend, not leaving a whole lot of room for acquisitions that are strategic, reinvesting back into yourselves at those historical 25% rates of return, or to be buying back shares strategically. But, I mean, it doesn't really leave a lot of room for debt either. So it looks like the years that they go into making an acquisition, their dividend payment's so great that they have to go into debt a little bit to fund that acquisition, which I do not like to see. I like a company to be smart with their capital allocation and be able to use what they create in free cash flow and not necessarily have to go into debt unless it's extraordinarily necessary. In most cases, it's not. Either way, let's get ready to make some assumptions here on the revenue growth side. It's an old company. You're not going to be seeing a lot of sexy growth here. I'd probably say 2%. I'd say that, maybe it's a little dampened for the next year or two, but I think, they'll be able to grow 3% a year. That's pretty much in line with inflation. I don't see why they couldn't. With margins, I mean, free cash flow's definitely been on the better side. So I'll say that maybe they're able to get their earnings back to those free cash flow figures. Were they just writing off some goodwill? Let's see what's going on. Yep. So big non-operating write-offs here. So this is likely an acquisition that didn't go well for them and they realize those assets are not worth what they bought them for. One-time expenses, if it happens all the time, they've made 3 acquisitions the last 10 years, so I'm not terribly concerned with that. But if it's an acquisition company and they keep doing that, might just mean they're not very good at making acquisitions, and you'd rather them focus their capital allocation elsewhere. But elsewise, with these types of margins, I'm going to assume maybe 11 and 13% share change. They bought back a little bit of shares, but not necessarily in the recent history. 1% would be about 177 million. I don't think they're going to be doing that, and they're able to do that with this dividend. So I'm going to say that they just offset stock-based compensation. Terminal PE, I mean, if they can get back to these types of return on invested capital, but they're not reinvesting anything. So it doesn't really matter if I can get 100% return on my money if I just give it to people in a dividend. That doesn't make me deserve a premium. And so for me, I think I'm fine with market average here, because it is a household name, but the amount of debt they have with free cash flow, not terribly concerned about it. But their capital allocation, I don't really like that. Growth isn't going to be really sexy. And for me, I mean, maybe they're one of those dividend aristocrats where they have to raise it every year, or they think the world's going to end. So I hate to do it, but I'll give them that 1% a year, because I'm saying that their margin will expand a little bit. They're growing at 2%. So maybe that 70% goes down to 60, 55% for a company this old. I think that I'm fine with that payout ratio. But personally, I mean, I'd rather them be more strategic than just hand something out in a dividend. But the yield is a 3.4% yield. So it's a very healthy yield. Quite a bit above the S&P 500. So it is a good yield, but I mean, again, it's a huge payout. They have a little bit of debt, not the healthiest dividend I've ever seen. So either way, we're saying the company's stock price needs to fall 55% before you get the return to look for here. So I will just be waiting and reviewing other companies in the meantime. Hope you enjoy the video and have a great rest of your day. Thank you.